for got it. Thank you, Annie.
Got it.
We're just waiting a few minutes for some latecomers to arrive. On behalf of Kent Invicta Chamber of Commerce, my name is Kaz Macklin. Thank you so much for joining us. With us today, we have Team Chamber in the form of Annie Breen, who will be pressing all the magic buttons and keeping us in line and on time. Our keynote speakers today are Advanta Wealth. I'd like to introduce Peter Colechin and Nathan Pitt-Stevens, who will be walking us through this webinar today. Good morning, Nathan. Good morning, Peter.
Good morning.
Thank you so much, gentlemen, for
supporting
supporting the Chamber event and for joining us today.
Thanks for having us. Appreciate it.
You're very, very welcome. To all of our guests, thank you for your time. Matthew Scheinborn, good morning. And welcome.
Hello, everyone. Hi.
Good to have you with us, together with Jill, Anna, Dominic and Linda, Fiona and S. Christopher. Richard Hardy is with us as well this morning. Richard, good morning to you, sir.
Good morning, Richard.
I've never actually seen you in person. We've spoken on many occasions. So a delight to have you with us today, sir. Thank you so much for joining us. We'll probably have some latecomers coming in, and I'm hoping that they won't disturb you. But Nathan and Peter have worked terribly hard on this presentation, so I don't want to steal any of their thunder. So without further ado, Peter and Nathan, over to you. Thank you so much, gentlemen.
Well, thank you, Kaz, and thank you, everybody. I'm going to attempt to share my screen now, so somebody can help explain if I'm doing it right. So share. From beginning, we'll just run the audio. People can hear that.
Here's to the crazy ones, the misfits, the rebels, the troublemakers, the round pegs in the square holes, the ones who see things differently. They're not fond of rules, and they have no respect for the status quo. You can quote them, disagree with them, glorify or vilify them. About the only thing you can't do is ignore them, because they change things. They push the human race forward. While some may see them as the crazy ones, we see genius. Because the people who are crazy enough to think they can change the world are the ones who do.
"25 years since Apple launched its famous advertising campaign, thinking differently has never been so profoundly important as it is here in 2023. We're going to help you to realise through today's webinar what is possible for you and your wealth. Before I begin, I must pay thanks to Kent Invicta Chamber for this opportunity to speak to its members and perhaps some non-members who have also joined this morning. We'd like to warmly welcome you to new Chancellor, new year, new thinking. It would be rude not to introduce both myself and my colleague Peter. A little context for the audience predominantly, as I understand Kent Invicta Chamber members. Although building our businesses within Advanta Wealth's London office based in Belgravia, we live in Walderslade and Hempstead in Kent respectively. I love Kent. I've lived here for almost 8 years now, moving for love, as my wife did not fancy Coventry for raising our beloved sons, although thankfully she did fancy a Coventrian. Would you like to introduce yourself to our audience today too, Peter?
Yeah, sure. Mute off first of all. We all sounding okay? Excellent, thank you, Kaz. Yeah, good morning, everybody. So just before Nathan continues, a very quick introduction. We'll keep this brief because it's more about the future today and where we're looking at with New Year, New Thinking. I work for Advanta Wealth with Nathan. I've been just over 30 years actually practicing within the profession. I've worked for various banks and independent financial advisors. And the biggest thing I've gained from doing that in 30 years is the ability to share knowledge from our clients with other clients and being able to help other people in doing that. So I'm a chartered financial planner. I also hold the fellowship, the same as Nathan. He'll mention that a little bit later on. And we deal with personal and business holistic financial planning. Face-to-face, online, the medium's not a problem. We come to our clients regularly at their homes as well. Just a very quick as well introduction to the Advanta Solutions group before Nathan continues. So we are an independent firm of financial advisors. We're what's called whole of market, which means we're not tied or restricted to any particular provider. So we exclusively work on behalf of our clients. We do not work for any product providers that we deal with. Roots go back about 30 years. And we base our business on complete transparency, openness of service, and a team approach. So we're made up of 5 divisions. And just very briefly, Advanta Wealth is where me and Nathan work. We are full holistic financial planning. We have an independent mortgage division called Advanta Mortgages, completely independent, from first-time buyers to refinancing your fixed-rate mortgage to commercial lending. We have a risk department that looks at personal and business insurance as well. Just any lines of personal or business insurance you can imagine, we will look at covering that for you. And we have our own investment division and our foundation division as well, which I will leave to Nathan for a little while later to explain. So all in all, we're very proud to say that we are actually an award-winning business. We achieved the top 100 place in the Financial Times Advisor Awards a few years ago. So there's about 6,000 companies operating in advice in the UK. We hit the top 100. Last year, we hit the top 10, which was quite extraordinary for us to do. And we still remain in the top 120 today, which is great news. So that's a little bit about me, a little bit about Advanta Wealth as well. If I hand back to Nathan at that point, he'll take you on to the next section.
Thank you, Peter. So we are both fellows of the Personal Finance Society, which means we have more qualifications than any other financial advisor you are likely to meet, and lots of experience. It means we can handle the deeply complex and explain it in a way that's that is understandable and importantly personal to you. As independent financial advisors, that's what we do for our clients every single day. Key to this service is independent thought. You are complicated because you're an individual. Your circumstances are not the same as the person next to you in the Zoom, if you like. You have tailored needs, and that is what Peter and I deliver. So enough about us. Let us launch new Chancellor, new year, new thinking, differently in 2023. We're going to review the key aspects of the quasi-budget, or is it statement? The mini budget in September, or Jeremy Hunt's autumn statement in November. Yes, it is the former Health Secretary, still the Chancellor for now, who has outlined the current state of play, and we will accurately outline the rules as they are now for you. So Peter's going to reflect on the changes Advanta have made as an organisation, explore the ways you can structure staff benefits and to take advantage of allowances available to you. Although you've not come specifically for this, please indulge me for a brief few minutes to highlight the wonderful cause of the Advanta Foundation, so profoundly important for the charities we support. I will show you how you can ease staff anxiety at the rising cost of living crisis, explore ways to keep your people primarily more happy and hopefully also more productive, explain how you could purchase your commercial premises through your pension and maximize value through cost control, cash flow management, and to take more of what you've earned. And as is our primordial raison d'etre, explain how you can do more with your hard-earned money by investing your wealth tax efficiently in 2023. We would love to hear from you and we would love to talk to you, but a webinar has obvious limitations. If you think you might benefit from our services, please contact me. My details will be shown at the end or message us via the web chat during the session. At the end of this session, I will also let you know about a financial MOT offer that we are extending to you as delegates at our cost. Let us start by looking at the budget. For clarity, we are speaking about the autumn statement set out by Jeremy Hunt last November. What the people in the video you watched earlier had in their favour, of course, was considerable imagination. More than this, it was also information and knowledge on their subject matter. So we are now going to take you through some of that detail. To bring this to life, we're going to run through some case studies during the presentation. But before we take you through the key changes that will impact businesses and individuals in the tax year starting 6th of April 2023, we thought we would give you a bit of quick trivia. If you ever wondered why the UK's tax year starts on April 6th, when most countries operate in the calendar year in England and Ireland, the new year used to start on March 25th, also known as Lady Day. All accounts, including debts and rents, had to be settled by then. With a number of changes to the Julian calendar becoming the Gregorian calendar, to ensure there were no loss of tax revenues, Treasury extended the 1752 tax year by adding on 11 days to the start of the new year, and consequently the beginning of the 1753 tax year was moved to April 5th. But that doesn't quite explain why we ended up with the 6th of April as the start of the tax year. Well, in 1800, a further adjustment was made, shifting the start of the tax year forward by one more day to April 6th. The year 1800 would have been a leap year under the Julian calendar, but not the Gregorian one. So the Treasury treated 1800 as a leap year to get an extra day's revenue. Listen, folks, it seems the revenue do not miss a trick, so why should you? Let's look at the headlines. We're going to keep this at high level, as we could speak for an hour on any one of these. Having explained why the tax year runs from the 6th of April, we do, of course, have to immediately point out that the charge to corporation tax is effective from 1st of April. This will be affecting companies with profits £250,000 and over. Companies with profits below £50,000 will continue to pay 19% tax, and those with profits between these two figures pay a tapered rate. In terms of the national insurance thresholds, freezing these means you and your business, if you employ people, will pay significantly more of this in what has been termed a £150 billion stealth tax raid. So moving to personal tax, the three main taxes that impact an individual's planning are income tax, capital gains tax, and inheritance tax. Unsurprisingly, all these taxes were hit, but some in surprising ways. Perhaps no surprise was the reintroduction of additional rate tax. Earnings above 125,140 will now be taxed at 45%, giving us a 20%, 40%, and 45% tax banding. Yes, you do have a tax-free personal allowance, but that was frozen at the current level. And is tapered for those earning more than £100,000 by £1 for every £2 over that limit. So those with taxable income of 125,140 or more pay income tax on every single penny they earn. Later in this presentation, we'll explain a way to reintroduce your personal allowance if this impacts you. The allowance to receive dividends tax-free is up to £2,000, has been cut to £1,000, and in the 24/5 tax year will reduce further still to £500. If an additional rate taxpayer cannot shelter those dividends in, say, an ISA next year, they will see an additional tax bill of £450. This won't work in the cash ISA you would get in the bank or building society, as when sheltering dividends from tax, we're talking about stocks and shares, ISA and pensions, but more on this later. The biggest surprise was perhaps the reduction in the amount of tax-free capital gain that can be made. It was reduced to £6,000, a reduction of more than 50% this April. In April 2024, it will further reduce to £3,000. The self-assessment wrinkles still exist though, so if the gain is less than the tax-free allowance, but the sale proceeds are more than 4 times the allowance, the disposal does not need to be recorded in your self-assessment. So if you plan to sell some assets soon, this could impact you. So talk to us and perhaps we can aid you to think differently about how you do this. The inheritance tax thresholds remain frozen at £325,000 until 2028, and with a standard rate of charge of 40%, many more estates will be subject to this tax. Already, the Office of Budget Responsibility predicts revenues of £6.7 billion this very financial year from this tax alone. Of all the taxes here, this is potentially the most contentious and the one fraught with emotions. Gifting rules have also suffered severe fiscal drag, which basically means, as the rules have not changed for almost 37 years, that more tax gets paid as the allowances don't increase with inflation or wages. So before running through some case studies later, we are going to be talking about things like inheritance tax and planning for that. What I'd like to do is introduce you to Peter again, who's going to talk more about our company reflections on the budget.
Thanks, Nathan. So we thought we would just give you a little bit of background here around just our thoughts as a company on the budget and what happened, particularly last year. I guess the budget, the best way to describe it is kind of, was it ripples on the pond, or was it really a complete crashing set of waves coming on the shore, because it changed so much in what happened in such an extraordinary short space of time as well. So now Nathan's in charge of the slides here, so I'm going to do my kind of Dr. Witty bit here and ask him next slide as he moves along. So thanks, Nathan. He'll just jump along as we go. So reflections. Think back to last year. So Boris resigns in July. Along comes Liz Truss. She lasts a whopping 44 days, and her Chancellor the lovely Mr. Kwarteng, he lasts about 38 days as Chancellor. So if you saw the press at the time, you would have seen the headlines used, the kamikaze budget was the phrase they used. Yeah, slightly harsh on him to say the least, but it was a problem. And that's before you even factor in everything that happened with the war in Ukraine. So we had domestic issues, we had global issues in what was happening. So Jeremy Hunt comes along, takes over as Chancellor, and the biggest thing he had to do, if you reflect on last year, and you think of the news last year, was he had to settle people's nerves. And the biggest thing he had to achieve as well was he had to stabilise sterling, because what happened at the time, you probably saw on the news, interest rates, and particularly government bonds, started to go through the roof in terms of their returns. And it meant that countries around the world started to lose confidence in the UK. So something had to be done quite quickly. The biggest thing you would have seen was the impact on interest rates. So mortgage interest rates started flying through the roof. Panic started to kick in, and some of that is lingering now. We're still seeing clearly high interest rates and the impact of inflation that's come along since then. So as Nathan mentioned earlier, what happened? Well, taxes had to be played around with, and the biggest thing that he's really done is the freezing of the tax thresholds right through to 2028. So Nathan mentioned personal allowance, dividend allowances, bits and pieces like this. They've all been frozen or reduced, which means you get something called fiscal drag, which is basically all of us and more of us being dragged into the tax net. You get zero rate taxpayers becoming taxpayers, basics becoming hires, hires becoming additionals potentially. So it's a very clever way to raise taxes without saying we've put up the rate of income tax through policy, through government policy. So hence thinking differently, we have to think differently about how we can actually counteract some of these measures. And then if you look at the news now, we've moved away slightly from, oh, look at all the tax changes. What you'll see happening is the Chancellor, Mr. Hunt, is talking completely about growth. If you look at the news now, it's all about what growth is needed in the economy. And that, believe it or not, is the headlines you're seeing on the news even today. The government needs growth in its plan. And in fairness, Liz Truss was trying to do that. She just jumped on the biggest roller coaster on the planet and tried to do it literally overnight. So Jeremy Hunt is all about stability, which is the word he will continuously use. And I think he will continue to use when he certainly talks to the financial markets as well. So we have a very complex tax system, change is constant, but the best thing to do, of course, is to have a plan rather than no plan, which is really where Advanta is coming in, to start thinking about these things. And that really leads into talking about what we did as a business, some of the things, and moving away from some of the financial aspects now. So some of the softer issues that we've done to help as a business in supporting our staff through the financial crisis. Some of these you'll think, well, that's pretty obvious. We do that already. Some you might think that's interesting. We'll have a go at that and see if that's something we can do. And you're welcome to consult with us on anything you think you'd like guidance or advice on as well. So just starting on the first one I'll show you. This is probably one of the most common ones you will see amongst businesses, but it's one not to be forgotten. And I guess I'd start this by saying everything isn't about just pure salary and wages. Of course, it's important, it pays the bills, we understand that, but there's lots of things that can be done, particularly to help staff when you're thinking about their actual mental well-being and their healthcare at work, which has a huge financial benefit, even if it isn't directly feeling like pounds in their pockets. So again, think differently, think beyond just the numbers, and then we can see what sort of things we can do to support people. So the one you've got on the screen now, excuse me, don't worry too much about the numbers. This is probably one of the most common ones you'll come across, which is the salary sacrifice arrangement, which many companies operate and many advisors will talk about. So this example on screen is around a pension scheme, typical pension scheme within a company. We have an employee who's earning around 24,000, basic rate taxpayer, company and the employer pay into the scheme. The simple concept of salary sacrifice is, rather than the employee just paying into the salary, into the pension themselves. The employer can agree to give up a portion of their salary and exchange that for a pension contribution made directly by the employer. So rather than the employer and the employee chipping in, the employer makes the entire contribution. The employee doesn't pay in anymore. They simply sacrifice their salary to that amount, let the employer pay the money in. What's basically happening when you look at this is you're getting effectively the same pension contribution, black line at the bottom, 1920, but the take-home pay is increased for the individual on the right-hand side after the salary sacrifice. And the simple reason that's happening is because of national insurance. So if the employer makes the contribution, the employer doesn't pay national insurance on the contribution, and the employee doesn't pay national insurance either. So there is a saving. And when you think about national insurance rates at the moment, you've got employers paying close to 14% and employees paying around 12%. There can be quite a significant saving if the pension contributions start to get quite high. So if your business is running effectively a staff-based employer scheme, particularly under auto enrolment, it may be compulsory now, then have a think about, does it involve salary sacrifice? If it doesn't, certainly you can speak to us and see some methods you can do this and get either the take-home pay up of staff and try to get them a bit more money in their pocket. Net effect is exactly the same. You get the same pension, but you get more pay in your pocket in certainly times of crisis like now, with the cost of living hitting us as well. There are a few things to bear in mind on this. Obviously, there's some parts that it won't apply for. Speak to us. Some staff it's not applicable for. We can't go through all those today, but if you consult with us, we'll show you what's relevant on there. The other thing to bear in mind is if you run a death in service scheme, there's ways in which you can reduce the rates that you're paying on that as well. Again, it's just the trigger point. If you're doing this and you're running a sickness scheme, make sure you take advice on it. Don't just leave it to run for years and years. You need a good employee benefits package. And the same with private medical cover. PMI is private medical cover. It's a benefit offered to many staff. Again, make sure it's costed correctly and you've got your pricing right to make sure you can get benefits there as well. I'll show you what we've done in just a moment within our company. Nathan, you okay if you just push along one more slide for me? Thank you. So what are we doing that's thinking differently in our company? So these are just some ideas on what we've done to change our business. As I say, some of them are very straightforward, but some of them you might find of interest. So again, Nathan, if you could just move on one slide for me. Thank you. Okay, so this can apply to any of your companies and anybody within the chambers as well. So the main one we've got there is the personal financial awareness session. So anybody within a business can effectively take an MOT to have a checkup on what their situation is, what are the best money saving tips they can have. And we do this within our business, and any companies we look after, we will offer any staff effectively a financial MOT if they want to. It's just the starting point to say you need to know where you're beginning from, what you've got, what the gaps are, and where you're trying to get to make that process begin with an advisor. Salary sacrifice, we've just mentioned, that's something that can happen within a pension scheme. And again, we'll make sure that happens with any companies that we work with. I mentioned about death in service schemes as well. They're often called relevant life schemes or group life schemes. Some of them are more beneficial than others. So again, talk to us if you've got one of those running and it hasn't been reviewed. Have a look at what you're doing. We'll give you some guidance on what can happen there. We also run an electric vehicle and bike scheme as well. Again, you can do this through salary sacrifice. So there are benefits to be had here. You may run it already within your company. Electric vehicles are, I guess there are love them or hate them at the moment. They're getting there. They will do. And that's part of the climate change government policy. So the world of EVs, electric vehicles, is with us. We're going to have to deal with that. So why not do it through your scheme? You can offer staff a huge amount of benefits by doing that as well. Private medical, the one I mentioned just earlier. So our scheme, slightly different. Private medical schemes in the past were very reactive. It was a case of, I'm unwell, please can you fix me? Schemes nowadays are completely proactive on what they do. So they will say, how can you improve your health? How can you make things better? to give you less chance of falling ill and give the employer more hours back effectively. Get better quicker, get you back into the workplace, whether that's physical health or mental health. So we have a full champion within our business that promotes the full benefits of our healthcare cover in what we do. We have flexible working. We have dress for your day as well. So we can look at how you want to come to work, reducing carbon footprints. We offer examination support for what we do for our staff, upskilling the workforce. And we have referral schemes as well, where you can effectively have a scheme where all staff are entered into a draw to win effectively money or prizes at the end of the year. Quite common with some companies. Again, we do it. Lastly, I've just got on here, these are some of the more simple things that you may think these are in our office already. But yes, we have LED movement sensors within our office. We have energy saving devices, cloud-based servers, which many companies use now. Simple expense claims processes for our staff so they can get their money back quickly, just treating them fairly. And we've obviously promoted recycling as well. And of course, video calls like this, conferencing. Since COVID, that's been a huge change in what we do, changing the way we work and when we travel. So I'm just going to hand back to Nathan at this stage, because he's going to tell you a little bit about the Advanta Foundations and the charity, which feeds in nicely to what companies can do to support the more philanthropic side of businesses as well. So Nathan, go ahead with the foundation, please.
Thank you, Peter. We had a little sound check earlier, so hopefully this is good. Recognizing that the current cost of living crisis can create social breakdown on an international scale, as well as focusing the funding needs of children suffering with ill health, we've recently sharpened our focus on our charity events to benefit children impacted. In 2022, we are proud to share the actions of our staff, all of whom are encouraged to consider the plight of suffering children and raise awareness of our staff, all of whom are encouraged to consider the plight. Raised and distributed over £100,000 to various children's charities in a single year in 2022. In August 22, 9 colleagues and I competed the 4 Peaks Challenge, Ben Nevis, Scafell Pike, Snowdon and Slieve Donard, which contributed a quarter of the fundraising achieved. Here is an image of us at Loch Lomond on the way to Fort William on a gorgeous sunny August day. Personally, I found the most difficult of all the peaks we climbed was the fundraising, and was proud to play my part in achieving the £25,000 milestone we set out to, a real team effort. Perhaps we felt the absence of one of the original volunteers in her home country of Wales, halfway up Mount Snowdon. In 2023, our absent Welsh friend is bravely embarking to Costa Rica with another group of volunteers from the business. The foundation continuing apace, highlighting the relentless nature of our activities and driving to support those in need. This is a picture of Sophia from Saturday in training for Costa Rica. One of the charities the foundation support is very close to Sophia's heart. Latch Wales support children who are receiving treatment for cancer at the Children's Hospital for Wales and their wider families. Sophia contributed to the fundraising, also did a huge amount of organising, without which I could not have boarded my flight back from Belfast International Airport. Losing my boarding pass due to board the plane, Sophia came to the rescue by sending the e-ticket to me within seconds of me reaching out to her on the Sunday. Safe to say, I was tired after the 4 days of activity and limited sleep, and grateful for the intervention. We continue to fund emergency supply trips to Ukraine, led by brave volunteers, Claire Chappell, Melissa Charles, and the ubiquitous and influential foundation chair, Gillian Piggott. So thank you for indulging us on our charity updates, guys. Back to the day jobs. We cannot comment on the mini budget without recognising the impact both this and the subsequent autumn statement have had on interest rates, and in particular mortgage rates. It's highly likely that if you employ people and their families, they may have a mortgage. And we're fortunate that as independent financial advisors, we have an in-house mortgage team, so can provide a review for each of our staff to find the most suitable loan based on the entire marketplace. The same loan is available to you and your staff through the same service. The key things here are: think ahead, don't leave any review until the last minute. We recommend speaking to an advisor 6 months before a fixed rate deal expires. For the self-employed, lending criteria can differ from lender to lender. So speaking to an advisor presents the best chance of getting the best mortgage deal that works for you. These can seem frightfully difficult and challenging times for homeowners. Whilst our mortgage team is incredibly experienced, we've all got used to interest rates since 2009 that are historically low compared to long-term averages. That phase appears to be ending. Remember, we do not set the rules of the game. We're here to interpret them and help you play to your potential on the financial field. Prudence and pragmatism become the watchwords. Overpaying the mortgage where you can, getting your finances ready for higher payments, and paying off expensive debt first. Having a positive credit reference is also key. To get the best credit reference, use a card little and often, only use 30% of your limit, check your credit report and fix any mistakes, get on the electoral roll, avoid making multiple credit applications in a short space of time, use an eligibility checker and get your name on some bills if it isn't already. Paying down your mortgage reduces your liabilities and increases your assets, but this should be part of an overall plan, not something to be considered in isolation. Pay yourself first, and for those who don't know, that means save every month. Oh, and look out for fraud. Many credit report companies offer free 60-day trials, which include access to fraud teams. The impact of interest on debt is going to become more acute. Life accumulates. You can either accumulate debt or equity. This year, choose to think differently, choose equity. With 13 million workdays lost due to poor financial well-being, there is an ever-increasing onus on the business owners to ensure they look after their staff and ensure they not only but also their employees experience healthier and happier times in work. Recognize any problem early can be crucial. Happier staff are more productive. With the relationship between Kent and Charles Dickens, I'm going to be moving on to a few personal finance case studies now, and I hope you'll forgive me for a rather obvious bit of plagiarism for my first case study. So Bill enjoys his work at the Ghost of Christmas Present Limited, where he wraps children for gifts for children like Tiny Tim. Bill feels a little bit forgotten about. All his higher earning colleagues have a pension they have, and they've been automatically enrolled into because of the legislation that came into effect in 2012. So all of his colleagues receive employer contributions, income tax relief and national insurance. Bill feels a bit left out and he wants to opt in. So he asks his employer for contributions, yet Bill does not earn more than the £6,240 qualifying earnings threshold. So they legally have no requirement to pay it. His line manager, Ebenezer, decides not to pay into his pension. Furthermore, Mr. Marley is a non-taxpayer. His earnings are also less than 12,570, and hence he does not get any tax relief. Luckily, Bill and I talk regularly about all manner of things, and he's asked me about this issue. So with 10 years to invest for retirement, he wants to retire at 75. A personal guarantee he'll not need access until he's 75 as a Christmas gift on the morning from his line manager. I recommend Bill invest 2,880 net, £3,600 gross per tax year into a stakeholder pension, where he will receive £720 income tax relief every year, even as a non-taxpayer. At a cost of £28,800 over the next 10 years, he builds a fund big enough to help with his retirement. Moral of this story, everyone can benefit from tax relief on a pension, even if you don't have any earnings. It's even possible to take out a pension for a newborn child. And that advice there was worth at least £7,200 in income tax relief to Bill, and that's without any fund growth over that period. Let's now look at another way income tax position can be improved with a bit of planning. So these clients earn £60,000 a year each, and they have dependent children. Frustrated by the fact that their salary, just in the 40% tax bracket, the higher tax bracket that is, was not providing them with the lifestyle they desired, enabling them to afford to plan for their future. Now in their 50s, they want to start getting some planning in place. And despite the word pension being smeared, as it has for many years of poor press reports and scandals, it is a friendly word that you give it credit for. A £10,000 salary pension exchange kickstarts their saving and changes both the tax position and entitlement to child benefit. So this year, in 2023, think differently and perhaps consider a pension contribution if you fall into that and you have children. Even if they're teenage children, you may reintroduce the qualification for child benefit. So moving on from Jeff and Valerie, we recognise that Juliet here is in the top 1% of highest earners in the UK. And this is not relevant for everybody, yet for many of our London clients, high earning is part of a lifetime of dedicated work and aspiration. And this is where they find themselves. It's a privileged place to be. It's also taxing. This example illustrates how a pension saves Juliet paying an effective 60% income tax rate on earnings between 100 and 125,140, because she loses her personal allowance by £1 for every £2 over the 100,000 threshold, as we explained earlier. In addition to that, and that's an effective 60% income tax relief you can see there on your screen. Juliet does have a son, and she pays for some childcare for him occasionally, even though her earnings have been reduced to 100,000, which is the adjusted taxable income, in order to actually qualify and reintroduce qualification for tax-free childcare, she may need to make a charitable donation to our foundation, for example, receive some gift aid, and that will help to reintroduce qualification for the tax-free childcare as well. Moving on to an example about capital gains tax. So David, he'd like to sell some shares, and he approaches us for advice towards the end of last year. He's worried about the autumn statement tax changes. He's got stock in Ashted PLC, one of the best performing stocks of the last decade. He didn't need the money right away, and having purchased them in December 2019, he was already in profit territory. He was pleased about the initial rise. He's thinking about cashing them in, despite the fact that he likes the company he's invested in, and he's fretting at the potential for more tax on his profits after the autumn statement. Essentially, he's got an annual ISA allowance of £20,000, and his current Ashted holdings can be invested entirely in this wrapper, which ensures he's not subject to capital gains tax on any upside growth from now. So we can do this retaining the shares, what is known as an in-specie transfer into an ISA, meaning not only does David not have to pay any capital gains tax on any future growth, he also retains his full capital gains tax exemption, which helps him because he has a property in addition to his own that he'd like to consider selling also this year. David also invests with us in a pension, general investment account and bonds on our investment platform, and benefits from ongoing service. So Ashted PLC have just announced an expected 30% increase in revenue. David's excited. He's now thinking differently about his shares. He's no longer concerned by the £150 billion stealth tax raid. He's dreaming of a bigger ISA portfolio to complement his pension with tax-free income as well as tax-free growth. And he's far more productive in managing his business with his financial peace of mind that our advice has given him. Okay, so we have left the big one until last. Earlier, we discussed the freezes to inheritance tax nil rate bands at £325,000 per person. For married couples who have mirror wills, joint assets and leave them all to each other, as is often the case, on first death, there is no inheritance tax charge on this transfer of assets to the sole surviving spouse. Crucially, the late spouse also transfers their unused nil rate band to the survivor. This means all marital estates potentially have combined nil rate bands of £650,000. For those passing residential property assets onto direct descendants, and this is a widely defined term, including and not limited to grandchildren, children, stepchildren, adopted and even foster children, there may also be the residential nil rate band of £175,000 per person. Similarly transferable, these combined bands ensure that a married couple with a family bequeathing £1 million of assets are not subject to inheritance tax. The more perceptive of you will have noticed that I have used words like may and potential throughout this story. First, an estate with more than £2 million of total assets, and this pretty much includes every personal asset that you own, that's a home, car, contents, valuables, second property, and so on, will suffer a tapering of £1 for every £2 of assets above £2 million they bequeath in their estate. Hence, some estates of higher value may not qualify for the residence nil rate band, or it may be a reduced band. The assessment of assets is undertaken on first death for a married couple as well as second death, and that's again in a marital estate. So careful planning to ensure qualification is essential, which we can achieve in partnership with legal professionals whom we work in partnership with. Tax legislation can and does often, if not as progressively as some as you may like it to in the UK, change. Hence, take care, review regularly as we suggest at least annually, ensure your affairs are up to date with the latest rules, and of course, most importantly, consider your own attitude to this tax, your own aspirations and dreams for your family. We are all living longer now. For most of us today, we've also discussed the challenges we face in the UK. I will begin here stating that alongside estate planning, Advanta Wealth have deep expertise and experience in the field of advising elderly clients on a range of concerns in old age and ill health. As they manage mobility challenges, mental health concerns, our advice offers opportunity to arrange your finances appropriately to plan. The Vulnerable Customer Charter sits central to everything and a brief example is a recently new client with a spouse with a degenerative condition, and we arranged bespoke combination of investments suitably structured to ensure their potential needs were fully anticipated. We also have expertise to help raise the funding required to cover care costs for your elderly relatives, as well as ensuring you have appointed lasting power of attorneys with the Office of Public Guardian who can save you or your relatives considerable stress and anxiety should you lose capacity. I've recently helped one of our clients in their 70s appoint all 4 of their children and each other as lasting powers of attorney with one of our legal partners. Equity release can, in certain situations, be very helpful. For example, where an aging relative needs funding to cover care costs and has a valuable property with relatively few liquid assets, often perhaps they have not sought advice soon enough and find themselves in this situation. It can be suitably arranged. As today is also thinking about differently, as well as a bit of inspiration, did you know that Okinawa is home to more centenarians than anywhere else in the world, and their diet and lifestyle might just hold the key to their longevity? The Okinawan Islanders have one of the highest life expectancy rates in Japan, with the average age on record as 90 for women and 84 for men. For those of you too young to remember him, this image is the actor Noriyuki Pat Morita, who played Mr. Miyagi in the classic Karate Kid movies. Sadly no longer with us, he would have been 90 in November last year. The character he played, Mr. Miyagi, a native of Okinawa, the lesson of looking after yourself remains true. As promised, in this section, we will weigh up the pros and cons of purchasing your commercial property in a pension. This is a highly specialised area where advice should always be sought and careful thought given to any such acquisition. Some business owners out there may be considering buying their commercial premises. So firstly then, the benefits. And then I'll obviously explain the drawbacks. So initially, allowing the taxman to help you to purchase some of your property, as we've already discussed, the pension policy allows individual taxpayers and corporates to save income and or corporation tax. Not only does this rent, in terms of another advantage to purchasing your property, would be to ensure that you own the property, as advocated by George Clason. If you've ever read The Richest Man in Babylon, it is a book that I would read for all avid financial planners. Again, owning your property and if your pension owns your business property, you'll still be a tenant, but your pension will be a landlord. And as it's your pension, not a third-party landlord, it will receive rent. And not only does this rent boost your pension, it's received tax-free. What's more, it's still treated as a business expense, reducing your profits and corporation tax bill. However, a formal lease must be in place and arranged on commercial terms. To put it another way, you can't give your business a better deal than would be available on the open market. Many business owners would rather pay rent to their own pension than a third-party landlord. There are many reasons to own your business premises in your pension, but it is still first and foremost an investment, which you hope will grow over time and provide you with an income in retirement. If you were to own your business premises personally or through a limited company, any profit when you sell it would be potentially taxable. This is subject, of course, to the usual capital gains tax exemptions if you owned it personally. Again, what I'm also going to do now is on a high level, essentially run through some of the drawbacks. Before I do, if I just explain again, owning property through your pension means that no tax is payable if you ever sell it. Owning your premises gives you far more control. It's not a free ride. Rent still needs to be paid on time and borrowing commitments, but must be met. But no landlord can ever decide to sell up from under you or arbitrarily and unfairly put up your rent. Many businesses need to borrow money to help them to buy a property. Certain to subject rules, your pension can do the same. So simply put, your pension can borrow up to 50% of its value to fund the purchase of property. Pension can borrow from a bank much in the same way as your business would do. Most banks are used to lending SIPs and SASs. In fact, many of specialist departments, and for those who don't know, SIPs and SASs are self-invested personal pensions and small self-administered schemes. Even if you don't have enough money in your pension to buy the property outright, there are several options to help bridge the gap. Again, these include additional pension contributions, multiple owners, joint purchases. And again, just to outline, if you were to die before your 75th birthday, regardless of whether you take an income or lump sum from your pension, your beneficiaries can also withdraw all the assets tax-free. Alternatively, they may prefer to retain the pension and take a tax-free income. Both options are available irrespective of your beneficiaries' ages. Again, if you die after your 75th birthday, the rules are slightly different. Beneficiaries can still take a lump sum or indeed retain the pension and take an income, but both options are then taxed at their marginal rate. So all sounding rather good so far, but you need to be aware there are disadvantages as well. Those disadvantages include access, trustees, liquidity at retirement, diversification. Of course, property is often going to be the largest asset in your pension. If you decide to take this route, it can be taking time to sell a property. If at retirement you're looking to take a lump sum from your pension, again, that may take some time to come through. Risk, obviously, is another downside. Your own financial future and your business premises is inextricably linked to the success of your business in your pension. This is magnified by using your pension to buy your premises, and obviously fees as well. Again, just very quickly, obviously, if you amass profits and decide to keep these, if you're a business owner, keep them as a cash reserve. Careful planning can ensure corporate investments that work better for you than traditional deposit with your bank. If, however, cash is your favored choice, then considering a cash management service will generally provide you with a higher interest rate return, depending on the size of the deposit. Spread these across a number of deposit takers. And for longer term investments, a corporate can invest in using what's known as a capital investment bond, and in doing so will be able to invest in assets such as stocks and shares. The next slide here, I'm just going to briefly explain how a business owner, director, can attempt to illustrate the differences drawing £50,000 from his business with some of the changes coming up. So the first way shows if he were to pay himself a salary, this salary would be a business expense against his corporation tax liability, and he would have a basic rate income tax liability of £7,486. The second example shows the dividend route, but please note the increase in corporation tax on the amount of profit you generate. So essentially, he needs more profits to take a higher net dividend because the increase in corporation tax rates. Ultimately, this further helps to illustrate that planning opportunities for you in partnership with a tax specialist and a financial advisor. Think differently. Again, owner directors can also pay themselves in employer pension contributions to save tax, saving corporation tax. It may also be suitable, depending on circumstances, to make a pension contribution from your net earnings. And this highlights the way that if you do, you can claim tax relief for both relief at source. And not forgetting today is the deadline for submitting tax returns for 2021-22 via your online tax return, especially if you're a higher rate taxpayer. Again, we'd like to thank you for today and also say that often our clients have needs that are complex. A sale of a business, an exit strategy, or complicated tax planning cases. Sometimes multiple advisors are essential to complete all of the work you need. What all of the characters you've seen in Apple's promotional video at the start had in common, as well as the infinite imagination to dream, was information, deep knowledge on their subject matter. As two fellows of the Personal Finance Society, more than 50 years of combined experience between us, I hope that this brief presentation has created in you the desire for information to enable you to think differently. I mentioned at the beginning of this webinar that we would like to offer any delegates a free financial MOT. This would be an investment of about half an hour of your time, an hour that will help you identify some of the examples we've discussed this morning that may well improve your financial planning and enable you to think differently. In some ways, Peter may agree, two fellows are better than one, so to speak. So again, thank you for all your time and attention today. You can see last couple of slides here in terms of compliance statements on the slide. I'll hand you over for any questions. Thank you.
Nathan, Peter, thank you so much. Very, very comprehensive. Such a lot of ground covered. And as for thinking differently, yeah, there's an awful lot of what you've said that has made me think, well, yeah, maybe there's something to that. So yes, it enables all of us to go away with a little bit more information than what we started with. Ladies and gentlemen, are there any burning issues that you would like to discuss with Nathan or with Peter? That's what I like. You've stunned them all, Nathan. As I say, a very comprehensive presentation. Well done, really well delivered, and it wasn't evangelical. So for me, who isn't a financial guru, I was able to process some of that information, and hopefully I will be able to go away and reflect on it. As always, these events wouldn't be what they are without the kind support of our members and our guests. As Nathan said, thank you you so much for sharing this hour with us. Was there anything else that you would like to add, Nathan and Peter?
I just wanted to say, in terms of the questions in the chat, thank you to Richard for that particular question there. It's a personal company owns a commercial property. Is there an advantage to transfer ownership of the shares or the property to a personal SIP? So again, these things, as I mentioned in the presentation, are very complicated. I think it's one personally to take away. I don't know if Peter has anything to add on that. We can come back to you, Richard, on that question. But Peter, do you have any thoughts on that?
Thank you. That would be useful, Nathan. Yes, Peter.
Yeah, I think, excuse me. Yeah, I think certainly that's worth having a conversation with me and Nathan about. We need to know a lot more about the company and the actual scheme and the property to see what it is. Sadly, the movement of property within a pension is probably one of the most complicated things you will do within a pension scheme, particularly if you're looking at shares in there as well. So, yeah, Nathan, did you say you've got those details recorded somewhere? More than happy to speak to Richard.
I mean,
do a bit more digging around.
If Richard wants to come off mute, I don't know, and sort of, give us a bit more detail, it might be useful. There might be time to do that now. I don't know if
I tell you what, Nathan, we don't want to use this forum as a clinic per se. What I will do is I will connect you with Mr. Hardy, if I may, via LinkedIn, and you can pick up directly with him if that would be all right, because otherwise it may become personal, and Mr. Hardy may not want
totally
that
agree,
information out on especially as we're going on to YouTube. But nevertheless, a really interesting question, and thank you so much for your sensitive approach, both Nathan and Peter. It only remains for me to thank Annie for pressing the magic buttons, and you'll get away with about 7 minutes to spare today, which is awesome. So extraordinarily well timed, Nathan and Peter. You haven't overplayed your market. Ladies and gentlemen, our next event upcoming is on Thursday at Kenwood House. Annie, was there anything that you wanted to add about upcoming events?
Not for now, Kaz.
Not for now. All of our events are on our website, ladies and gentlemen, at www.kentonvictorchamber.co.uk. Nathan, Peter, thank you to the Advanta Group. Really professional representation. I'm very pleased. Thank you so much for joining us. Sorry, you can hear my phone going.
If I could just say, Kaz, one thing, in the true style, if anyone, if Mr. Miyagi resonated with anyone in terms of pronunciations, in the film, famously, somebody says, somebody calls him Mr. Miyagi, and he corrects them to say Mr. Miyagi. So in a similar way, if I could say, Kaz, it's Advanta Wealth. Not Advanti.
Right. Thank you.
Yeah, thank you very much. And thank you everyone for listening. I know there's a lot we had to get through, but I hope you have a lovely day and really appreciate your attention.
So on behalf of